Live from New York City this morning. Good morning, good morning. It is Fed decision day. Your equity market slightly negative on the S&P. We're down by 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, Chair Powell kicking off a central bank trilogy. Alphabet results impress as Microsoft disappoints, and it's the turn of high-flying Meta after the close. We begin with the big issue, one and done or more to come.
This is likely one and done.
One and done. One and done.
It's one and done.
That's what I would do if I were there.
July 25 basis points hike.
That's in the cards.
Baked in the cake.
The done deal.
We'll have to see what happens from there.
Really, the only question is what happens after Wednesday.
What kind of signal do they give us for September?
The probabilities of a hike, after July are probably somewhat higher than the markets are currently expecting.
The timing of the next possible rate hike is October-November meeting.
It's going to depend on inflation as well as the growth trajectory.
They'll keep a rate hike on the table.
They want to leave the door open.
To emphasize that optionality.
We'll get a lot more data between now and then to try to figure this out.
Joining us now to try and figure it out, PGIM's Robert Tipp, Troy Gayeski of FS Investments. Troy, first to you, buddy. One and done or more to come?
Yeah, more than likely one and done. Hate to be completely consensus with everyone else, but if you look at the trajectory of the economy, obviously there's early stages of weakening in the labor market. When you look forward, it's tough to figure out where the drivers of growth will be other than consumption, perhaps factory construction or housing rebounding. So the most likely path is one and done, unless housing continues to reaccelerate and the labor market remains incredibly tight, which we think is unlikely.
Robert Tipp, which one is it?
Yeah, I think that is the consensus, and logically, looking at what's happened the last 20 years, you can come to that conclusion. My gut feeling, though, honestly, is that everything we've seen the last 40 years, the interest rates going from 20 to 0, we're going to see about 10% of that 20% drop in reverse on a secular basis. I have a feeling, this is not going to be a hugely inflationary environment, but you look at what's going on out there in terms of wages. If you listen from the bottom up from our credit analysts, what they're hearing in autos, in airlines, it doesn't really match what's going on in CPI. It looks like a robust economy out there. I think it's what you're going to hear from the chairman today. It's going to be no love. It's going to be, you can do what you want, take stock prices up and all of that. But we're going to do our job. We're taking rates up today, and we're going to stand by the ready. We're not going to let this thing get out of control, et cetera.
Well, let's touch on that a little bit more, just on the market stuff before we get to the news conference. Troy, 12 months ago, you'd sense annoyance from Federal Reserve officials if the market was where it is right now, if spreads were as tight as they are currently. Do you think the market cares, or rather the Fed cares as much about where the market is currently?
Yeah, it's a remarkable point, John, because as we've discussed in the past, financial condition tightening is one of the key channels for the Fed slowing inflation and the economy. And when you look at where financial conditions are today, on almost every metric, they're almost as loose as they were, at the end of 21. Obviously, the front end notwithstanding and the back end of the yield curve, but in terms of equity multiples or credit spreads, so bottom line, though, is when you look at the trajectory of inflation, the Fed has had success so far. Obviously, cores come down, CPIs come down substantially. I think the main worrisome point, and this gets to your other guest's statement, is that you continue to see incipient signs of inflation reaccelerating. The fact that the housing market's rebounded already as strongly as it has due to limited supply. Tom and Lisa were talking to the Teamsters union head before and mentioning how the power that labor has now, which is very reminiscent in the 70s. So, I think bottom line is they hike once, they keep the optionality to hike further, but they're not overly obsessing about equity risk premium right now or credit spreads relative to the trajectory of core inflation, service inflation, as well as CPI.
Just on the prospect of inflation reaccelerating, Troy, if we can follow up on that. I heard that from Max Kettner of HSBC, Francis Donald of Manulife, Andrew Hollenhorst of Citi. Andrew and the team have been writing about this for weeks now. This idea that post the summer you get this re-acceleration. Do you think there's a chance that we get that, Troy, even with a deceleration in growth? You can get a re-acceleration in inflation. And the reason I ask this question at the moment is because of Europe's experience. Germany in recession, inflation still sticky.
Yeah. Yeah, no, well, again, when you think back to how these inflationary cycles work and, the fact that all of these, whether you're printing money and cutting rates or you're hiking aggressively and shrinking the balance sheet, have these variable lags. And it's just like in markets, right? Like markets don't go down in a straight line. They don't go up in a straight line. Same for inflation. You have the base effect. You have the fact that owner's equivalence rents has been so important to driving inflation higher and now the expectation of lower. But as that trajectory changes, you could see CPI fall, you could see core fall. And if the labor market remains this tight, which we're highly suspicious of, as you know, you could see that modest reacceleration, which does lead to one further hike. We think it's unlikely, but it's still in the cards, given the variability and uncertainty surrounding these forecasts.
Robert, what's your take on the same thing?
Yeah, I mean, I think you answered your own question there. Europe, they're stagnating and they have higher inflation than the U.S. on a core basis. That is where you do not want to be. So while on the one hand, the credit conditions, the stock market, seeing that kind of exuberance, does the Fed want to stop that? It's not going to make them happy because I think they're concerned about afterburners, and that is something that on the margin they want to work against. Having said that, you want growth. That is what puts them in a strong position here, is if growth is really on a solid footing, then they can move tentatively forward, do some further rate hikes, bring about a landing on inflation, even though I think it's going to take a couple more years than they're thinking it's going to take. That's what it's looking like.
Two-part story today. Decision, 2 p.m. Eastern Time. 30 minutes after that, you'll hear from Chairman Powell in the news conference. Mike McKee's in D.C. He'll be there. Morning, Mike.
Good morning, John. Well, somebody asked me yesterday what the bond market is telling the Fed, and right now I have to say they're telling the Fed what day of the week it is because they change their minds constantly. Look at where we are in terms of anticipation in the futures markets. I'm looking at overnight index swaps. 97% priced in a rise today, but only 19% for September. If there is another rate rise, only 28% in November. But look at December. They're starting to price in rate cuts again. That's going to be Jay Powell's job today in the news conference, is to keep markets from doing that. And by that, he's probably going to be focused on inflation. And the CPI reports say one good CPI does not make a trend. No, we're going to keep an eye on this, and we are not going to be cutting rates this year. There are headwinds and risks ahead, and you've been talking about some of them with Troy and Robert. And another hike will depend on the data. Basically the same things that he has been saying. Now, here's a question, though, for Troy and for Robert. What are you going to do at 2:30? Remarkable story by Yi Xie and Matt Bosler from Bloomberg News today. During the news conferences, the markets have gone the opposite direction from what they did with the statement, and people have made a lot of money, at least up through February of this year. It's tightened up just a little bit because there's a little bit less uncertainty, but the bond market goes in the complete opposite direction during the news conference, as you can see. So the trade seems to be take a position on the statement and then bet the reverse while Powell is speaking. We'll see what happens today.
So, Mike, before I get to the panel on that, can we talk about the statement just briefly? There's a couple of lines in it that jump out. The lines around additional firming will be a focus for you, I believe, in the third paragraph. In the first paragraph, at the very end of it, they characterize where they see inflation currently. I wonder if, Mike, they're still going to describe that as elevated or give a little nod to the developments of the last couple of months.
My guess is that they will still describe it pretty much the same language. I don't think we'll see a whole lot of change in the statement because they don't want to give the markets an opening. If they acknowledge that inflation is coming down, then do people pile into that rate cut trade ahead?
Mike McKee, thank you, sir. Down in Washington, D.C. Looking forward to the news conference a little bit later on, 2:30 Eastern Time. 2 p.m. is when we get the Fed decision. Mike, thank you. Just to familiarize you all with the statement at the Federal Reserve from the last meeting. Inflation remains elevated, the last line of that. Troy, do you expect that line to stay in a little bit later today?
Yeah, I think so. I think so because, again, from their perspective now, they have made tremendous progress. There's more progress that needs to be made. The path from 4% core to 2% core is harder than 6 to 4, and there's really no upside to removing that language, right? Like, what's the upside if they remove the language and then equity multiples go up another 2 multiple turns, and we start having more credit expansion, which is obviously counter to constraining inflation. So from a risk reward standpoint, it doesn't make sense yet to remove that language. But to your point, they should give some nod to the fact that tremendous progress has been made. And at the end of the day, it's a delicate balance between continued labor market resilience and really crushing inflation, with a very strong boot, so to speak.
It's obvious also there's a split committee over on the FOMC right now, Robert, and I just wonder how you imagine he's going to deal with that in the news conference.
Yeah, I mean, I think these committees, they help. At any given point in time, you're going to get a wide range of views. You're going to get people that are looking deep inside the numbers, into all the corners of things that are decelerating. And then you're going to get people that bring it right back up to the top level and say, hey, listen, these are high numbers. You remember our narrative about the 70s and not wanting to repeat that. So I think, that gives them a very broad framework, is very inclusive as to possible scenarios, and that will get encapsulated. And it comes across as equivocating, but I think that's a healthy process. I think in terms of the market pricing of cuts, I think what you're seeing there is, rates have gone up 500 basis points. There's always a chance of a disaster. And there's an element of the market's pricing in a 2.5% chance of 500 basis points in rate cuts if something bad happens, and a 97.5% chance of no change for the rest of the year. I think that's what you're looking at. Personally, I think the markets are underestimating the meat of the scenario around here, of the probability spectrum right around these levels, where it could end up being a little bit higher. As Troy was saying, you could get one more hike after this one, to the extent that you have, a couple months of positive data or inflation coming back up on the upside. But there's a lot of different ways of looking at this, yeah. And I think the base case, for a lot of people, is a couple cuts over the next year, let's say.
Well, Robert, let's build on that and push it through the bond market if we can. What are you doing with the 10-year? What are you doing with the long end of the curve? Have you been buyers in and around 390, 380?
I think you have a real conflict here between the strategic view on the market and kind of the guts and the tactics of the curve. So from a strategic standpoint, rates have gone up a ton. You're at nearing the end, the final stages of the rate hike cycle. You're at a high interest rate level. Bonds are going to do well over the next 5-10 years. I think that's clear. In terms of what you buy, do you go into high yield? Are you buying your AAA high spread structured products that are floating rate, kind of barbell? And the reason for that is because the meat of the curve is expensive. Kind of your 2 to 10-year cash flows that are rock solid, assuming the Fed funds rate is going back to 3%. That particular part of the curve is overpriced. So I think bond market strategically looks great, but in terms of the internals, there's a lot to do to make money in terms of that wrinkled shape of the curve.
Troy, same question to you. What do you buy?
Yeah, Robert makes some really excellent points. And look, we would say from a real yield standpoint, you obviously have much more value at the back end of the curve now. Massively inverted yield curve notwithstanding, it's actually one of the expressions that we ramped up recently in our multi-strategy fund. And one of the key reasons for that is, again, when you look at the probability distribution of recession versus continued high inflation, it's certainly skewed in the direction of recession now, whereas the last 2 years, that was really an extremely low probability event. So we do like that for the first time in a long time. Secondarily, to Robert's point, if you look at structured products, whether it's CMBS or whether it's CLOs, you don't have to go down in the capital structure now to earn 7, 8, 9% type total returns, which, when you think about where equity multiples are relative to history, it appears to us to at least be competitive with equity returns at this starting multiple. And then in terms of, more private strategies, you think about the environment for lending right now. Obviously, bank lending stagnated after a surge last year and early this year. There's tremendous regulatory pressure and funding pressure on banks to retrench. So it's a great opportunity to be a private lender. However, you need dry powder to actually take advantage of it. And that's one of the key nuances that investors have to flush out as they're deciding which direction to go.
Hey, Troy. Thank you, sir. Alongside Robert Tipp, Troy Gayeski there, going into the Fed decision a little bit later. Thanks to you both. Equities right now on the S&P 500, negative 0.25%, about 15 minutes out from the opening bell. With some movers, here's Abby.
One reason those futures are down, John, has everything to do with Microsoft. Shares are lower. This, of course, after the company basically beat the surface level numbers, but folks are disappointed by revenue growth of 8%. This as the cloud slowed to 27% revenue growth from 31% in the previous quarter. That is weighing that stock down about 3%. And of course, one of the biggest weights to the S&P 500 and the biggest weight to the NASDAQ 100. Alphabet, on the other hand, up 6.1%. There was a big revenue beat driven by stable trends in ads on Google search, up 38% on the year into today. So now we do have some catch-up potential for this mega cap tech stock. And then finally, Boeing up 3.9%. They produced nearly $2.6 billion in free cash flow as jet deliveries surge and customer deposits come in. That is a 38% jump. They saw a 38% jump in some jet production. That is encouraging, John.
Abby, thank you. Thank you very much on the latest. Today is absolutely stacked. Meta after the close. Looking forward to Romain Bostic and the team. Scarlet Fu, Katie Greifeld breaking down those earnings for you later on this afternoon. That's Meta. Then we've got the Federal Reserve as well. There is a consensus around the Federal Reserve, the FOMC meeting and Chairman Powell, just the belief that it's one and done. But still, even though people believe it's one and done, the chairman's not going to commit to the done part. I've read this about 15 different ways. This was from George Concalves of MUFG in the last 24 hours. Likely the last hike, but they'll stay data dependent in case inflation flares up again. Maybe that's what we'll hear from Chairman Powell at 2:30 Eastern. Coming up on this program, this earnings season, it's all about one thing.
I look at this as a 1995 moment, biggest transformation that we've seen in tech in 30 years. This is just what's going to lead, obviously, despite Fed and macro. It's the start of a new tech bull market.
The latest on the AI effort. Alphabet impresses, Microsoft disappoints. It's Meta. Coming up later.
I look at this as a 1995 moment, biggest transformation that we've seen in tech in 30 years. I believe Microsoft, a year from now, it's going to join Apple in that $3 trillion, I think, $3.5 trillion. The stronger and get stronger. If you look at Microsoft, you look what we see out of Alphabet, that was a huge flex the muscles corridor for them.
The future of AI in focus after another mixed bag of tech earnings. Alphabet topping estimates thanks to its Google search engine. Microsoft seeing a slowdown in the cloud, overshadowing growing excitement for its new AI products. The CEO, Satya Nadella, saying, "We remain focused on leading the new AI platform shift and helping customers use the cloud to get the most value out of their digital spending." Let's get to the team coverage. Mandeep Singh, Anurag Rana of Bloomberg Intelligence. Anurag, first to you. What went wrong at Microsoft?
Only the expectations. Otherwise, the results were pretty good across the board. Almost every segment was slightly better than consensus. And the guidance was basically saying that the slowdown in tech spending may be taking another quarter or so on the cloud side. But the expectations, I think, were that they're going to see a big bump in cloud usage because of AI. And that's going to probably come only about a year from now.
Well, that's the question, isn't it? How patient do we need to be, Anurag, before we see that translate into real money?
I think it's really a question that, when you look at the software side of it, when you look at something like cloud infrastructure, it's not going to be done overnight. It takes a while to, come up with infrastructure, write those applications, then run those applications. Currently, people are just testing this out. So that's really, it's so subscale at this point that, as I said, it's going to take at least a year to 2 years before we see some kind of big usage on the cloud side.
I noticed that both the CEOs of Alphabet and Microsoft in the quotes in the earnings releases, Mandeep, both led with AI. This was from Alphabet CEO Sundar Pichai, who said, "Our continued leadership in, guess what, AI." Was yesterday just about basic advertising, getting it done for Alphabet?
Yeah, and they talked about their large language model, the new version, Gemini, which they're going to be releasing, a multimodal version of, think of GPT, which is quite popular now. And what Alphabet showed yesterday is they are going all in terms of the AI strategy. The product cadence would improve. And it shows on the search side. I think a lot of people were concerned about the impact of ChatGPT on search volumes. That didn't show up in the results, and you had a nice beat on the search.
If you're a Meta investor, after a run-up of close to 150% year-to-date, Mandeep, did you like what you heard yesterday from the likes of Alphabet?
I liked what I heard from Alphabet, but not so much from Snap. And I feel Snap is a closer competitor to Meta than Alphabet is. And on the social media side, I get the sense it's still the recovery in ad pricing is still in the early stages. So my sense is, look, Meta is going to do great on the free cash flow side. They're going to pare back on Reality Labs. But when it comes to engagement on the Blue app, that will continue to be a headwind for them, and that's where the top-line acceleration will take a while.
Got it. Mandeep, thank you. Mandeep Singh there. Anurag Rana to the two of you from Bloomberg Intelligence. Thank you. The stocks, the performance, obvious. Alphabet is higher. Microsoft is slightly lower. That's the good, the bad, the ugly. As Mandeep pointed out, Snap down by 18% in the pre-market. Coming up on this program, the morning calls, and later, Crossmark's Victoria Fernandez on the big opportunities outside of big tech. Plus, Loop Capital's Rob Sanderson weighing in on the latest results from the tech titans after the close yesterday, and looking ahead to Meta a little bit later. From New York, your opening bell, 7 minutes away. 5 minutes away from the opening bell this morning. Good morning to you. Chairman Powell a little bit later, going into all of that, into the open. Equity futures right now on the S&P, slightly negative by 0.25%. That's the price action. Here are some morning calls. First up, Raymond James downgrading target to market perform from a strong buy, cutting shares by 2 notches due to weakening traffic trends and easing sales momentum. Deutsche Bank upgrading Spotify to buy, 180 price target, saying the stock's post-earnings sell-off is now overdone. And finally, Citi raising its Alphabet price target up to 153 following earnings, pointing to a strengthening advertising market and numerous AI benefits. That stock is up by more than 6%. Coming up on this program, Alphabet beats, Microsoft disappoints, big tech results continue with Meta after the closing bell. That conversation up shortly with Crossmark's Victoria Fernandez and Loop Capital's Rob Sanderson. Your equity market slightly softer, your opening bell just around the corner. 24 seconds away from the opening bell this morning. Good morning to you all. On a bit of a winning streak on the S&P 500, just a bit softer at the moment going into Chairman Powell Day decision this afternoon. Equity futures down by 0.2% on the S&P. Some underperformance on the Nasdaq driven by what's developing in Microsoft after the close. There's your opening bell. With equity futures just a little lower on the Nasdaq too. Let's turn to the bond market. Yields are lower by a couple of basis points, 386.28. In the FX market, a euro bouncing back, 6 consecutive days of euro weakness, replaced by a little bit of strength. Euro dollar 110.68, we're positive there by 0.1%. WTI just short of 80, $78.88. We're negative there by almost 1 full percentage point. About 20 seconds into the session, the S&P 500 looks a little something like this. We're negative 0.2%. On the Nasdaq, we're just a bit softer as well. The stock to watch at the open, Microsoft, the company posting tepid sales growth and forecasting a continued slowdown within the cloud business. The CEO saying this: we remain focused on leading the new AI platform shift and helping customers use the cloud to get the most value out of their digital spending. Abby has more. Hey, Abby.
Hey, John. Well, it's not surprising that this stock is lower right now, on pace for its worst day since the beginning of June, down about 2% or so, given the fact that on the year coming into this report, it had been up somewhere closer to 50%. So price to perfection to some degree, and that revenue growth slowdown that you're talking about, the revenue growth for the quarter that they just reported, about 8.3%, on that cloud slowdown, not offset by optimism around AI, saying that AI is going to be a little bit, it's going to take longer to get it going, whereas the cloud, that's 41% of their business revenue. So I think that the big concern here, John, is that we could see this slowdown continue. And if you look back at Microsoft over time, between 1999 and 2016, it never made a record high from its bubble peak because of that slowdown. If you look at the Microsoft modeling right now, it has been in single-digit growth for quite some time. So I think, again, the fear is that it will stay stuck here and that that's going to weigh on the stock.
Pretty sure Joe has a moustache now and long hair. Abby, thank you. Very different look. Abby, thank you for that. Just around the opening, about 2 minutes in then, equities down just a little bit. Abby went through one of the losers, Microsoft, one of the winners, Alphabet, topping Q2 estimates thanks to robust advertising within its search business. The company saying this: generative AI is supercharging new and existing ad products with tons of potential ahead. Mandeep, good to see you again. They're saying all the right things. Are you seeing it turn into real money?
Well, so look at how Google is going to grow their top line going forward. One, they have that daily active user base of 3 to 4 billion users to the search product. So they're not going to add more users. They're going to focus on driving engagement. And that was one of the biggest risks with ChatGPT is, can it take away the engagement? And I think when you parse out Google, as a combination of search, maps, and all the apps they have inside, that is where, a Bard or the next version of generative AI could be very powerful in terms of driving engagement. They missed the boat with social media, but I feel that's what they're focusing on. How do we drive engagement? And I think they said all the right things last night.
Mandeep, with that in mind, what does the president and chief investment officer do at a tech firm?
Well, so I think Ruth Porat's elevation is not a surprise given, how well she did with cost cutting this quarter. And they need that focus when it comes to driving the bottom line. I think if you're thinking this company can compound EPS at, low to mid-teens over the next 5-10 years, you need both the top line focus and bottom line. And I think Ruth has that experience, both with her street experience, taking stakes in smaller companies, because Google obviously can't buy any company now. And I can see more of that happening, given what Microsoft did with OpenAI early on.
Mandeep, just quickly, Meta later. I asked you briefly about the read across from Alphabet to Meta, thinking that perhaps we get a lift for Facebook too. And you picked on Snap, and I'm going to talk with Simone about Snap in just a moment. Yeah. Why is Snap the cleaner read on what may or may not happen with Meta later?
Well, so social media advertising is different from search because, the advertiser base is more concentrated, although in the case of Meta, it's mostly small businesses, and we know small business sentiment is improving. I think why Snap didn't do well is, one, a function that their engagement growth somewhat tapered, and that's because of TikTok and all the competition, from Instagram. But I do think, ad pricing has been slow to come back. And right now, what we saw is probably advertisers focusing on the highest ROI spend, which is Google search.
Mandeep, thank you, sir. Snap getting absolutely hammered this morning by almost 20%, a fifth of the market cap, just like that, in the first 4 minutes of trading, getting slammed after delivering a disappointing guidance. The company saying this: we remain in a period of rapid transition as we work to improve our advertising platform despite limited visibility for demand. Simone, that does not sound good, does it?
No, it doesn't. You don't love to hear a rapid transition. Net loss coming in a little bit lighter than anticipated, but as you pointed out, John, it's all about that revenue forecast. This second quarter was the second straight quarter where year-on-year revenue fell, and then when you look out to the third quarter, Snap looking at for $1.07 to $1.13 billion in revenue. Analysts we're looking for that top number. I think you're seeing somewhat of a comparison of what happened at Alphabet, just such strong commentary around ad revenue. Meta's ad revenue expected to come in pretty hot as well. And there are rising costs as Snap invests in things that will draw more consumer engagement. 70 cents per active daily user, up from 58 cents a year ago. There are a handful of encouraging signals, however, if that's really what you're looking for and you believe in the Snapchat product. 397 million daily users, that's up 14% from a year ago, especially strong user growth outside North America. John?
Tell that to shareholders this morning. We're down 20%. Simone, thank you for that. That one brutal, ugly around the opening bell. Let's turn to semiconductors. Texas Instruments posting a weaker than expected Q3 outlook. The CEO saying this: similar to last quarter, we experienced weakness across most of our end markets. Katie has more. Hey, Katie.
Hey, John, even with the bright spot in the automotives, Texas Instruments currently down by about 5% as trading kicks off after delivering a pretty lukewarm forecast. The chip maker sees third quarter revenue coming in between $4.36 billion to $4.74 billion. Now, the midpoint of that range is below the average analyst estimate of about $4.59 billion. And again, automotive, it was the bright spot here. But outside of that segment, you heard from the Texas Instruments CEO saying that customers, they're continuing to cut their orders of new chips. They're instead choosing to rely on their existing stockpiles. And not to mention, you also have order cancellations hovering near elevated levels. So you add that all together, of course, it's weighing on the stock this morning, and it could have implications for the broader industry here, given that Texas Instruments usually seen as a bellwether, John.
Stock is down 5%. Katie, thanks for that, breaking it down for us for the semis and beyond. We're about 7 minutes into the session. Equities at the moment negative by, let's call it 0.2% on the S&P. On the Nasdaq, down by a little bit more. It's a monster week for big tech, but better news could be in other sectors.
I think tech is going to be a loser. Why would you pay 40 or 50 times earnings when you can get companies with superior earnings growth that are cyclical at a fraction of the cost?
There's a lot of anticipation and good news already priced into the mega cap names. There are opportunities elsewhere. We do think that this earnings season could be a catalyst for a broadening out of this rally.
We've heard so much of that over the last few weeks. Victoria Fernandez also looking beyond just the tech sector, right in this. We want to be invested but remain cautious throughout the second half. Stay invested and find the parts of the market that will perform best in certain environments. Industrials have begun to show some leadership. Use this sector for some cyclical exposure. Victoria, I'm pleased to say, joined us now. Victoria, let's go straight to it. Why do I want to buy cyclicals with month after month after month of declining leading economic indicators and an inverted yield curve?
Yeah, it's a great question because, as you know, we actually anticipate a slowdown later in this year. So you're right. Why do I want to be in cyclicals? But I think it's because you have to have a balanced portfolio, Jonathan. So many people have been focused on that tech sector. And, you know, for a long time, we were actually trimming those high-flying names because we didn't want to have so much exposure to those names. And we were looking in other areas within tech. But at the same time, we said, look, you can't underestimate the consumer. We do think there's going to be a pullback later this year, but the consumer continues to spend. We heard it from Visa, where they said they don't really see that much of a slowdown in consumer spending. So I think you need to have some exposure there. Like I said, industrials have been taking a leadership role, so maybe you can look at some of those names. Construction has actually been moving higher. Manufacturing construction of plants has actually doubled in the last 12 months. So look at some companies maybe associated with that. And I think you also want to have some staples in your portfolio just to give you that diversification within your portfolio for the volatility we see ahead.
Well, talk to me about what's funded that. I'm looking at what you've trimmed. Hilton, Bank of America, Kroger. Why those three names? Do they have anything in common?
Well, what they have in common is their outperformance over the last month and the trends that we're seeing. So obviously there's been this whole revenge travel going on all summer. But we heard from Alaska Air yesterday where they're seeing domestic travel really start to slow down. We saw Southwest come down a little bit because of that. So domestic travel coming down means hotels will probably not do as well. Hilton has had a really strong month. They were up over 10%. So trim a little bit of that name. You don't have to come out of names completely, but take a little money off the table, appreciate your wins. It's the same thing with Bank of America. 10% in a week. Why would you not trim some of that and look for other areas, names that have been hit, and put some money there? And Kroger is the same way. They've had strong performance, 5% performance as of late. We're starting to see food inflation maybe go back up again. You look at grains, especially wheat. We're seeing commodity prices move up, so there could be some margin pressure there. Go ahead and take some wins. That's the theme across the names.
So this is the equity market. My question to you to start this conversation: why buy cyclicals with the data going in the wrong direction, the leading economic indicators? Why buy cyclicals with an inverted yield curve? Here's the question on credit. Why do I want to buy credit as defaults start to pick up? Make sense of that for me.
Well, it depends on where you're buying within credit. I agree. High yield spreads are so tight right now. And to me, that's a warning sign in the sense that we know if there's going to be a slowdown, we know if there's going to be margin compressions coming in as inflation comes down and pricing power is affected, those high yield names are going to be affected first. So I would avoid high yield. I would look at investment grade names. And within that sector, yes, spreads are tight, but I think those companies that have strong balance sheets, that have good cash flows, those are the names you can have bonds in, whether it's short term to get higher yields on the short end, combined with a barbell on the longer end of the curve to lock in some yields, because I think yields are coming down. We probably hit that peak yield back in the fourth quarter of last year for this cycle. So if yields are coming down and you've got good quality credit names in your portfolio, you can cash in on your coupon and maybe get a little bit of spread tightening still with those names, and you'll be well positioned.
We've been talking for more than 5 minutes and haven't even mentioned the Fed on Fed decision day. So here's a dangerous question. Do you care what Chairman Powell's got to say at 2:30 Eastern? Does it make a difference to your investments that you've just walked us through?
It doesn't make a difference in the near term, Jonathan. We know they're going to hike 25 basis points, or at least I say we know, 99% on the futures say that. And they're probably going to be hawkish. I think people are anticipating that. I don't think there's going to be any surprises that are going to change my outlook on the economy. I think we're going to wait and see what is said at Jackson Hole. We know there's a longer time period than usual between this meeting and the September meeting. Jackson Hole's right in the middle. Let's see if that's where they start to change their story a little bit. That's going to be more interesting to me than what we hear today.
Interesting. Victoria, thank you. Victoria Fernandez there, Crossmark. On this market, what she's been trimming, what she likes in equities and in credit, and looking ahead to Chairman Powell a little bit later at 2:30 Eastern. Just to go through the calendar for you, August 10th, that's going to be an inflation print. Then on September 13th, another CPI read. So they're the two CPI prints between this Fed meeting and a September meeting, which takes place at the back end of September, around September 20th, I believe. Back end of August is when you get Jackson Hole and potentially an address from Chairman Powell. Any rush to commit to a pause? Today in the news conference, as consensus stands, the belief is there will be no rush to commit to a pause later on this afternoon. We'll see. Full coverage, of course, coming up a little bit later on Bloomberg TV and on Bloomberg Radio. Coming up on this program, looking ahead to Meta earnings.
When we look at the performance in some of these big tech companies so far, what we need to wonder is how sustainable it's going to be.
It is one of the big winners of the year so far. That conversation up next with Loop Capital's Rob Sanderson.
When we look at the performance in some of these big tech companies so far, what we need to wonder is how sustainable it's going to be. And AI is an exciting story, and eventually it's going to translate into earnings, and there's no question about it. What we need to determine is how much time it's going to take.
Microsoft and Alphabet setting the stage for Meta after the closing bell. Investors looking to earnings to justify the stock's monster gains this year. Year to date, Meta up by more than 140% already in 2023. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, we'll see if the year of efficiency continues to pay off for Meta. Of course, even though shares have tripled since November, that was off a 7-year low. And if you look at valuations right now, Meta currently trades at 20 times its projected earnings. That's a lot. But then you look at the NASDAQ 100, and that trades at 26 times. So we'll see. That's the valuation backdrop. But I want to talk about the fundamental story for Meta because it is fascinating. Of course, there's going to be a lot of focus on the metaverse. Of course, maybe we'll figure out what it is. There's going to be a lot of focus on ad sales, of course, given that Meta derives nearly all of its revenue from advertising. And there's going to be a lot of focus on Threads. Of course, that's Meta's challenger to Twitter. It launched this month, Twitter, now known as X. There's a lot of lofty projections for what Threads could deliver to Meta's bottom line. Evercore, for one, estimates it could generate $8 billion over the next 2 years. I'm sure we're going to hear a lot about it in the next few hours.
Katie, thank you. I think we're all waiting for this one. Year to date, Meta up by close to 150%. Loop Capital's Rob Sanderson looking ahead to results, saying this: recent conversations with advertising industry contacts point to continued resilience in digital ad markets and are particularly encouraging. Rob, I'm pleased to say, joins us now. He has a buy rating on shares of Meta. Rob, I've been looking forward to catching up with you because I was reading your research yesterday evening, and this is a line you don't usually read around a name that's up triple digits year to date. Sell-side expectations for Meta look conservative. Rob, what's conservative about them?
Well, I think people have accurately captured the cost reductions, and that's been the bulk of the revaluation in the stock this year. And that's less interesting to investors. I think the efficiency is certainly important to the bottom line, but it's sort of a one-time thing, and it's priced into the stock. What we're excited about is revenue acceleration, and I think we're looking at like we heard from Google last night, pretty healthy trends in ad markets compared to what was initially a very cautious expectation. So better than expected, I think, is the takeaway versus the backdrop. But Meta's really getting its mojo back in product, and that's, I think, very important for the stock and for the multiple.
Before we get to product, let's just sit on ad spend for a little bit more. Rob, I had a guest on a little bit earlier this morning who had a different opinion on things and said that maybe Snap was a better read on ad spend than Alphabet, rather, for the likes of Meta. Why is Google a decent read compared to, say, what we heard from Snap?
It's about 70 times larger in terms of advertising dollars. Snap's a very small player in a big ocean. Obviously, the revenue scale of Alphabet is unlike anyone in the space, including Meta. But Snap is a very small player. I think moving through some very company-specific issues. And the incremental dollars there really wouldn't move the needle for a company the size of Meta or Alphabet.
You mentioned product as well, so let's switch to that. Threads. Sure. Rob, is it too early to get excited about Threads?
I think so. I think Threads is very nascent in its, it's a curiosity at this point. Certainly has long-term potential, but again, Meta's business is really driven by the core apps, and they're so scalable. Even if Meta were to replace Twitter's revenue base completely, it's like 5% of advertising revenue for Meta. I think it's quite early to be excited about Threads from a moving the stock perspective. I think it's really about the core ad products, and Reels is really the star of the show here, not Threads.
What are you seeing in Reels, Rob, that you think can underpin a re-acceleration in revenue for a company that large?
Yeah, well, the engagement growth has been phenomenal. That's something that's been, I think, known for some time. The time spent on short video products, TikTok, obviously very well known. But Reels is distributed to, Meta has 3 billion daily active users. The reach is unparalleled. And now it's not just engagement growth. We're really hearing strong indications from the ad buying community that the platform's performing very well, not just for brand objectives, but now for lower funnel, performance objectives as well. And a lot of money is moving into this exciting new format, delivering fantastic results for advertisers. And I think there's a lot more to come here.
I'm with you on the doom scrolling, Rob. I've now set a limit on my phone to about 2 hours because of these short videos, which you just keep sweeping through. Rob, can they actually make that much money from advertising on that?
Yeah, they can. The engagement's phenomenal, as mentioned. But it's working. That's what we're encouraged about. Is when we talk to advertisers, they're getting results, and they see a very significant amount of headroom to continue to put more money into this format, and that's on top of what is already working in stories and feed and other formats across the Meta platform. The other product story is on Advantage Plus. This is an ad platform for advertisers that's using AI to help manage campaigns, very early in its ramp, and again, feedback's been incredibly positive. And together, I think this is really helping Meta get some of its mojo that was lost over the past few years. Their reputation in the ad community is certainly on the upswing.
Super addictive, that's for sure. Rob, enjoyed this. Thank you, sir. Rob Sanderson there on Meta coming up a little bit later. Just things you don't usually hear. Triple-digit gains, and you've got an analyst bullish saying that maybe things are too conservative, switching the focus from the price cuts driven by the collapse of the stock at one point last year. And now we're talking about the product and a re-acceleration of revenue. Meta seems to be getting it done. The results coming up later. Let's see if they can disappoint or impress with a pretty high bar going into results. From New York this morning, your trading diary up next. Equities down just a little bit. That's the price action. Here's your trading diary. What an afternoon. Chairman Powell coming up at 2:30 Eastern. Decision time at 2 p.m. Meta after the close tomorrow. An ECB rate decision. US GDP onto Friday. We round things out with the BOJ. We round things out later with a stacked lineup for Fed coverage. Bob Michael at JP Morgan Asset Management headlining that for you. Plenty of others as well. Looking forward to catching you a little bit later from New York. This is Bloomberg.